Welcome to your Mortgage Insider update for Monday, June 24th. Pretty slow start to the week. Not a lot of big news after kind of big news last week. The federal government's deeper in debt, going to issue a lot more treasury bonds. So we would have seen a little bit more improvement in interest rates if it wasn't for the government announcing having to print a lot more money through U.S. Treasury bonds. So we're going to take a look at the charts and see how that landed. So we'll start with the 10-year Treasury today, sitting just below 4.25, so 4.247, 248 rounding up, pretty low. It wasn't just a little while ago we were talking about 4.5% rates on the 10-year Treasury, as high as 4.71 just on April the 25th. So we've been on the seesaw, we've been on the roller coaster. We get ourselves to a point where we're in a happy spot. Of course, we want to see rates improve further from here, but steady would be better for the general consumer to be able to make decisions. Because when rates jump up 0.5% in a week, and you're a home buyer, it really makes it challenging to have that news just basically pull the rug out from underneath you when you had just worked on your maximum pre-approval. So long term, we are hoping that the Federal Reserve will start to cut interest rates. But even as they decide to cut interest rates, the more U.S. Treasury bonds that come on the market are going to add to the supply. It's going to add to the cost of inflation. Basically, it's going to print more money, put more money into the system. And that is the concern right now, above and beyond just waiting on the Federal Reserve to tip their hat that they're going to start to cut the rates, which is still likely going to happen late this year. Take a brief look at mortgage-backed securities as well. So the mortgage-backed securities work in the inverse of the actual interest rate. So a consumer is going to pay a lower interest rate if the investor is having to pay a higher dollar for the bond, right? So as we've seen prices go up since the beginning part of June, and similar to the 10-year Treasury, kind of flatten and stay in a good spot well above all the averages. So we want to see long-term this to take off, and as the mortgage bonds come on the market, that's going to bring more supply if more people are able to buy homes. Right now, there's not a very big supply of these loans because there's just been less historically over the last, say, 5 to 10 years, less loans being given, not because of not so much demand. There's not enough homes to buy, which continues to be the problem. So as we look for more supply and more opportunity for homeowners out there to trade up, I know there's a lot of people that would like to buy another house, but with the cost of interest being as high as it has been, it's going to take a little more time to get used to it. And at the same time, I think everybody's hoping and wishing and waiting for the days for the rates to come down a little bit to make that opportunity pencil a little bit more securely for many homes. So if you have any questions, need to just sit down and run some numbers, we at Mortgage Insiders would love to help. Feel free to give us a call back or a text anytime. Take care.